I want to start with something that I think most people in the financial media get fundamentally wrong about passive income and retirement. The number that gets thrown around as the threshold for financial independence, the amount you supposedly need before you can stop working and live off your investments, is almost always larger than the reality requires. It is shaped by worst-case assumptions, by financial industry incentives that benefit from managing more assets, and by a failure to think clearly about the actual structure of a retirement income portfolio. I have worked with people living comfortably off $500,000. I have seen it done with $300,000. These are not extraordinary cases or people with unusually low expenses. These are ordinary people who understood what kind of portfolio produces income versus what kind of portfolio produces growth, and who built the right type of portfolio for the phase of life they were actually in. The distinction between those two types of portfolios is what this video is about, because the asset allocation that is correct when you are building wealth is not the same as the asset allocation that is correct when you are living off wealth. Conflating the two, which is one of the most common mistakes I see, either leaves significant income on the table during retirement or introduces unnecessary risk during the accumulation phase. I am going to walk you through 4 categories of income-generating assets, explain how each works and what the genuine risks are, and then show you specific portfolio structures for different capital levels. The goal is not to give you a formula to copy. The goal is to give you a framework to understand, because the right portfolio for your situation depends on variables specific to you: your actual expenses, your risk tolerance, your other income sources, your timeline. Let me walk you through the complete picture. The 4 categories, understanding the full spectrum. There are 4 broad categories of assets that generate income, and they exist on a spectrum from maximum safety with lower yield to maximum yield with meaningfully higher risk. A well-constructed distribution portfolio draws from multiple points on this spectrum, rather than concentrating entirely at either end. The reason concentration at either end is problematic is different in each case. Concentrating entirely in the safest, lowest yield category, cash equivalents and short-duration instruments, produces a portfolio that is secure but insufficient. The income generated will not keep pace with the actual cost of living over a retirement that may span 2 or 3 decades. Concentrating entirely in the highest yield category produces a portfolio that generates impressive income in the near term, but carries risks that can impair or eliminate the capital base, ending the income stream permanently. The skill in building a distribution portfolio is in blending these categories in proportions that match your specific income needs with your specific risk tolerance and your specific timeline. Let me describe each category clearly. Category 1. Cash and cash equivalents. This is the foundation. High-yield savings accounts, money market funds, short-duration treasury instruments, certificates of deposit. In the current environment, these instruments are generating approximately 3.3% to 3.5% annually, with some longer duration instruments approaching the low 4s. The role of this category in a distribution portfolio is not primarily to generate income. It is to provide absolute stability, a buffer that remains intact when equity markets decline sharply, that allows you to cover near-term expenses without being forced to liquidate equity positions at depressed prices. Every distribution portfolio should have some allocation here, even if the absolute return is lower than other categories. Category 2. Quality dividend-paying assets. This category encompasses individual dividend-paying stocks with long, unbroken histories of dividend maintenance and growth, as well as dividend-focused ETFs that aggregate these characteristics across many holdings. The defining feature of assets in this category is reliability. Dividends that have been maintained through recessions, through financial crises, through extended periods of market stress, combined with lower volatility than the broad equity market. The tax treatment of income from this category matters significantly for after-tax cash flow. Qualified dividends, income from stocks held for the required duration from companies structured as regular corporations, are taxed at long-term capital gains rates, which for most people is substantially lower than ordinary income rates. This distinction has real dollar consequences and should factor into how you structure the portfolio across account types. The yield in this category, typically 2.5% to 4% on diversified dividend ETFs, is not dramatic. That is intentional. The lower yield comes with lower volatility and greater income reliability. This category is providing stability and moderate income, not maximum income. Category 3, covered call ETFs. This category is where significant income generation becomes possible, but where the structure requires careful understanding because these instruments are frequently misunderstood and sometimes misrepresented. A covered call ETF holds a portfolio of securities, often tracking a major index, and simultaneously sells call options on those holdings. The premiums received from selling those options are distributed to investors as monthly income. The result is a yield that is substantially higher than the underlying securities would generate through dividends alone, often in the range of 10% to 15% annually for major covered call ETFs. The trade-off is specific and important. By selling call options, the ETF caps its participation in upside moves. When the underlying securities rise sharply, the call options that were sold limit how much of that upside the ETF captures. In a strongly rising market, a covered call ETF will underperform the underlying index. In a flat or mildly declining market, it will outperform through the income generated by the option premiums. There is also a tax dimension that requires attention. Some of the monthly distributions from covered call ETFs are classified as return of capital rather than income, meaning they represent a return of your original investment rather than a new gain. Return of capital distributions are not taxed when received. Instead, they reduce your cost basis, creating a larger taxable gain when the position is eventually sold. This is not inherently bad. It is effectively tax deferral, but it needs to be understood clearly because the headline yield on a covered call ETF may include a substantial return of capital component that changes the tax math considerably. Category 4, higher yield speculative income instruments. This category includes instruments that offer yields significantly above conventional income assets, sometimes 10% or higher on an annualized basis. The higher yield reflects higher risk, and the risk in this category often comes from sources that are not immediately obvious from the headline numbers. I want to be direct about this category. Assets in it should be sized as a small, carefully considered portion of a distribution portfolio, not a dominant position. The income they generate can be meaningful, but the capital risk they carry is real, and a distribution portfolio that loses a substantial portion of its capital base due to a high-yield instrument failing cannot be easily recovered. Before allocating to any high-yield income instrument, understand the underlying asset clearly. Understand how the dividend is generated and what conditions would cause it to be reduced or eliminated. Understand the tax treatment of the distributions. And size the position in proportion to the risk, not in proportion to the yield. Portfolio structure at $300,000. Let me now translate this framework into specific portfolio structures at different capital levels, starting with $300,000. I want to be honest about this starting point before presenting any numbers. A $300,000 portfolio generating enough income to fully replace the income most Americans need in retirement requires meaningful risk. There is no mathematical path from $300,000 to $40,000 or more in annual income using only conservative low-risk assets. The yield required, roughly 13% or above, cannot be achieved without allocating substantially to higher-risk income instruments. For someone in this position, I would structure the portfolio primarily around covered call ETFs in the middle of the risk spectrum, instruments with substantial documented track records, not experimental or newly launched products. The allocation would be heavily weighted toward covered call ETFs on broad established indices, with a smaller allocation to higher yield instruments and a minimal cash allocation for near-term expense coverage. The honest assessment, a $300,000 portfolio structured to generate the income most households require, involves genuine risk to the capital base. This is a workable structure for someone who has additional income sources, Social Security, a pension, a working spouse, that provide a floor, with the investment portfolio supplementing rather than fully covering expenses. It is a more stressful structure for someone whose living expenses depend entirely on the portfolio generating its targeted yield continuously without interruption. If you are in this position, the priority question is whether there are ways to reduce the required yield, lower expenses, additional income sources, a longer accumulation period, before moving into a distribution portfolio structure. Portfolio structure at $500,000. At $500,000, the picture changes meaningfully. The required yield to generate typical retirement income, approximately $42,000 annually from the portfolio, assuming Social Security or equivalent supplements the rest, drops to around 8.4%. That is achievable with a blend of covered call ETFs in the middle of the risk spectrum, quality dividend ETFs, and a modest allocation to higher yield instruments without requiring extreme concentration in any single high-risk position. My preferred structure at this level blends 5 elements in proportions calibrated to the income target. The largest single allocation, approximately 30%, goes to a quality dividend ETF. This is the portfolio's stability anchor. It generates moderate yield, it holds through market stress better than growth equity, and its qualified dividend income is tax efficient. It is not the income engine of this portfolio. It is the shock absorber. The next tier, approximately 40% combined, goes to 2 covered call ETFs on established broad market indices. These are the primary income generators. The blend between them can be adjusted based on the specific tax treatment of their distributions and the investor's tax situation. This portion of the portfolio will underperform in strongly rising markets and will generate its designed income more reliably in flat or moderately declining markets. A smaller allocation, approximately 10% to 15%, goes to a covered call ETF on a more stable underlying asset. Gold-based covered call structures have this characteristic. The underlying asset is less volatile than equity indices, which makes the option premium generation more predictable, though the headline yield is sometimes lower. A small allocation to higher yield speculative instruments, no more than 5% of the portfolio, provides additional income without creating existential risk to the capital base if the instrument underperforms. This is sized as a meaningful contributor to income without being a portfolio-defining position. The remaining allocation, approximately 10%, stays in broad market equities without an income focus. This position is not generating significant current income. Its purpose is to provide some participation in long-term equity appreciation, which protects the real value of the portfolio over a multi-decade retirement horizon. At $500,000, this structure can generate approximately $40,000 to $45,000 in annual income, reaching the income target, with a risk profile that is manageable rather than extreme. Portfolio structure at $1,000 and above. At $1,000, the income target is comfortably achievable with substantially lower required yield, which means lower risk. The same structural blend that generated $40,000 to $45,000 from a $500,000 portfolio generates $80,000 to $90,000 from a $1,000 portfolio without any changes in allocation percentages. If the income target is higher, $100,000 annually, for example, the required yield is 10%, which is reachable by modestly increasing the covered call ETF allocation at the expense of the pure equity allocation. The risk profile increases slightly but remains well within the range of a sustainable, manageable distribution portfolio. The important structural advantage at this capital level is resilience. If a portion of the portfolio underperforms, if a covered call ETF reduces its distribution, if a higher yield instrument encounters difficulty, the income from the remaining positions can absorb the impact without creating an immediate income shortfall. The portfolio has margin. At this level, the equity allocation for long-term growth can also be more substantial, potentially 20% to 30% of the portfolio, providing meaningful inflation protection over a retirement that may span 30 years or more. The critical distinction: accumulation versus distribution. I want to close with the point that I believe matters most practically because I see it confused regularly. The portfolio structure that generates income efficiently, the blend of dividend ETFs and covered call ETFs I have described, is not the optimal structure for building wealth. It is optimized for extracting income from an existing capital base. During the accumulation phase, when the objective is to grow capital as efficiently as possible over a long time horizon, covered call ETFs are typically the wrong tool. They cap upside participation, which is the primary mechanism by which wealth accumulates in equity markets over decades. The accumulation portfolio, heavy in growth equities, broad index funds, reinvested dividends, is different in composition, in tax treatment, and in the behavior you want from it. It is built to grow. The distribution portfolio is built to generate income from what has been grown. The transition between these two structures is one of the most important financial decisions you will make, and the timing of that transition matters. Moving into distribution assets before you have reached your target capital level reduces the growth that would have occurred if you had stayed in accumulation mode. Staying in accumulation mode after you need income means foregoing the income your capital could be generating. Understanding clearly which phase you are in and building the portfolio appropriate to that phase is foundational. If you are still building toward your target number, the distribution portfolio structures I described are reference points for the future, not the current prescription. I want to hear what you are thinking in the comments, specifically which phase you are currently in and what your primary challenge is at this stage. The answers tell me what to address in more depth. Thank you for watching. Peace.